Good afternoon. I'm George McCarthy, president of the Lincoln Institute of Land Policy, and it's my pleasure to welcome you to our webinar on the federal COVID relief funding and financing tools for a more equitable recovery. So as you all file in, as we get everybody kind of situated, we're going to ask you to answer a couple of poll questions that should appear on your screen. In a minute, after everybody's had a chance to answer those questions, we'll see how everybody responded. Okay, and here's the first question. What type of institution do you represent? And you can, of course, I don't need to read through all the answers. You can just tell us, and you know what I'll do? I'll actually answer that myself. Okay, well, I can't vote. Anyway, so as you're answering the questions, I will go through a few kind of housekeeping issues. The first thing is this webinar is being recorded. And so that means that you'll have a chance to see it again on YouTube or through the webinar link that you use to connect to this, to the webinar. The second thing to know is the chat is turned off. And so if you need assistance and you need to get some help with something technical, you'll need to flag us in the Q&A area, and then Lauren Walensky will get back to you and help you with anything that you need help with. And if you have other questions, of course, questions that you want to ask any of the panelists, put them in the Q&A, and we'll get to them towards the end of the webinar. So, Lauren, I've only seen one of the questions. Maybe we can pop the second question up, give people a minute to answer that one too.
You just scroll down.
Oh, it's scroll. Oh, I see. Oh, there's the second question is, which of the following best describes your primary area of practice? This is good. So we get to know this, who's in the audience. And I think we'll just give you another minute to answer these questions as everybody joins us, and then we'll start off with the webinar. Okay, so Lauren, you want to show us the answers to the questions? I don't see them. There we go. Okay, we see that almost half. Oops, now I can't see it again. Oh, there we go. Almost half of the folks here are from local public agencies. There's a good spread of folks between foundations, impact investing, and other. And then once again, we're kind of dominated by affordable housing and economic development folks, which is not a surprise because the topic of this, oh, and urban planners. Oh, look, we get 31% of us are urban planners. So that's the #1 response. So, but we've got a very good spread of folks across a bunch of different areas of practice. So that's good to know. So thank you all for answering the questions in the seminar. So I just want to contextualize the discussion we're having here today because there's a few things that may be useful to think about as kind of opening comments. So there's this relatively famous quote from someone I've never heard of named Katori Hall that says, serendipity always rewards the prepared. And I take that to mean that very often people attribute a lot of advances that are due to luck as luck alone. But if you're actually going to be able to take advantage of something that's presented to you, you have to be ready to take advantage of it. And part of the reason I use that quote to get us going here is because a lot of the last 20 years have been, at least for me being surprised when big things happen and then big things happen in response. And so, for example, we had the .com bubble and the crash of the stock market at the turn of the millennium, and all of a sudden we went into a zero interest environment that persisted for now about 20 years, something that one wouldn't have anticipated, especially having seen the crazy interest rates we were paying in the 80s and 90s. Or the hurricanes of 2000 2005 came, and all of a sudden we're pouring billions of dollars into one region of the country to try to help New Orleans and Mississippi and the Gulf Coast recover. Or, the foreclosure crisis, and all of a sudden Congress coming up with $4 billion as part of the neighborhood stabilization program to help us address foreclosures and try to keep neighborhoods from falling off the edge. And then, of course, the economic crisis that followed, and the American Recovery Act with $787 billion targeted towards infrastructure investment and other ways to help the economy recover. And every time we encounter one of those events, we think about them as if they're unique, like, oh, we'll never see that again. And unfortunately, every time I've encountered one of those events, I've thought that, and then next thing you know, within a few years, another event shows up that puts it all into kind of a tinier perspective. So now we have COVID, and we have all this money that's being generated to kind of help us recover from COVID, and the numbers are just jaw-dropping. We're talking about trillions of dollars coming from the federal government that is now being made available to not just states and local governments, but also to nonprofit organizations, to different segments of the economy as a way to kind of into regular old businesses in terms of PPP, to try to get the economy kind of will keep the economy from falling off a cliff. So that's always good, but in every one of those cases, we're never really prepared to take full advantage of these moments when they present themselves, because well, I don't know. I guess we just assume that they happen every 100 years, and now we've had events that happen every 100 years seeming to happen every 5. So, but one of the things that I also want you to reflect on is that when we make these gigantic kind of efforts to recover the economy, whether it's during the Great Depression or coming out of World War II, the gigantic investments were made in infrastructure like the federal highway system, or the Katrina, or the Great Recession. We've very often done it in a way that generates kind of panic and generally bad behavior. And when we think about an equitable recovery, one of the things we'll have to admit, if we look at every one of those efforts to just really pump gigantic amounts of money into the economy from the federal government, we've actually exacerbated inequality, and particularly racial inequality, dramatically with the way that we actually use that money. So what that means is, if we want to try to find a way to recover equitably, we're going to have to think differently about the recovery than we have over the last 100 years when we pumped large amounts of money into the economy. And what that means is we're going to have to be creative and thoughtful, and we're going to have to find ways to very often push back on the federal government to make sure that they give us the room to think about making this recovery equitable, as opposed to just some panicked effort to just pump money into the economy and make sure it gets into the wrong hands and leads to bad outcomes like increased inequality, which is something we see happening already, with asset markets reaching record levels, and unemployment still in double digits, and inequality looking worse than it did during the Gilded Age. So equitable outcomes just don't happen. They're a result of strategy and intention, planning, collaboration, and real clarity of purpose. And so for us, we need to achieve those things. We need to achieve some clarity of purpose. We need to find ways to collaborate differently, and we need to find ways to plan to use these kinds of resources most effectively. So we asked David Rosen and Associates to give us some insight into at least some of the trillions of dollars that are coming from the federal governments over the next few months, to help us think about how we can align our forces to put that money to good use. And we did this for our cohort of 13 states that are working with us to find ways to more creatively make investments. And we thought that it would be more useful to just offer this up also as a public service. So we asked David to give us this presentation twice. We just did it a couple of hours ago, and now we're going to offer it to you. So David and Nora Lake Brown have prepared both a guide and some notes and some insights into some of these federal funding sources, just to help us whet your appetites and your imaginations to think differently about how we can use this money to get to a more equitable recovery. And with that, I'm going to hand this off to my colleague, RJ McGrail, who leads our Accelerating Community Investments project, and he'll introduce some of the topics, and David and Nora. So take it away, RJ.
Thanks, Mac. Thank you all for being here today. One thing in particular, in addition to the guide and the project-based financing tools discussion that David and Nora from DRA are going to lead, we wanted to sort of level set the conversation today in a particular piece of the trillions that Mac mentioned earlier, the $350 billion that is currently on the street, at least 50% of it, to eligible states, localities, tribal governments, and territories to broadly support COVID-19 response efforts, support economic stabilization, strengthen support for vital public services, and most particularly to address the systemic public health and economic challenges. This is language directly from the interim final rule that Treasury produced. We think it creates an opportunity, as Mac was mentioning, to push thinking, both in states and localities. In this case, the deep money, $350 billion, kind of sizing the opportunity with this visualization here, given the size of this pool of resource, plus potential further infrastructure investment from Congress in the future, we just want to reinforce that this presents a significant opportunity for states, localities, tribal governments, and territories to get innovative, creative, and serious about ways in which to use this resource to truly advance a more equitable recovery. The last thing that I think any of us want to realize is to look 2 years and 4 years and 6 years from now and see increased spatial concentration of poverty and increased deep inequality of economic outcomes, having had the opportunity to do something different with the trillions of dollars needed to do so. Our colleagues, and there's some of them on the call today, I believe, in the impact investing ecosystem, sort of define themselves as having a focus on investment that's informed by two things, intentionality and impact. We think that there's an opportunity to apply a similar lens to these coronavirus relief funds. States and cities can look to attract investment partners, focusing on and being clear on intentionality, about place, about people, and being clear about impact measurement, pushing beyond outputs or what's produced as a result of an investment to what communities and people historically left behind get from those investments. Our talk today is really designed to promote that thinking about the more flexible general use resources in the coronavirus state and local fiscal recovery fund pool, as well as a series of project finance tools. I'd like to introduce David Rosen and Nora Lake Brown of David Rosen and Associates, their contact information and some brief language on their international reputation for excellence in economic development and public policy and financial advisory. David and Nora are now going to walk us through their summation of the project finance tools in their resource guide, which we did provide to registrants earlier today, and help to curate a discussion and Q&A of example innovative use cases that might prompt some thinking for you. We are going to hold a chunk of time at the end to discuss your ideas and take your questions. So please feel free to use the Q&A function to offer those up. And with that, I'll hand things off to Nora and David.
Good afternoon. This is Nora Lake Brown with David Rosen and Associates. We're going to bring to your attention federal finance and funding programs from 4 different departments today: Department of Treasury, the Department of Energy, Department of Agriculture, and the Small Business Administration. And as RJ mentioned, we want to bring these to your attention because they have received significant additional funding under the various COVID relief measures and or have had some recent changes in their requirements or regulations that may make them more useful to you folks. So the first one from the Department of Treasury is the Emergency Capital Improvement Program, which received $9 billion one-time funding allocation. Eligible applicants include low and minority income community development financial institutions, or CDFIs, as well as minority depository institutions, or MDIs. And these youth funds can be used by the CDFIs and MDIs to provide loans, grants, and forbearance to businesses and consumers in low and moderate income and underserved communities. We particularly bring this program to your attention as the application deadline is soon arriving on July 6th of 2021. And as RJ mentioned, each of these programs is outlined in further detail in the reference guide that you have received, which also has a number of links to websites, regulations, and even applications in some cases, as well as to some of the lists of CDFIs and MDIs. The second program is a brand new program. The Emergency Support and Minority Lending Program received $1.7 billion in funding. Eligible applicants include CDFIs again, as well as minority lending institutions. And this is a newly created category for this program, which has not been defined yet. In fact, there are not many details about this program out yet. We understand the eligible uses will include financial assistance, training, awards, and outreach programs. We expect the rules to and application deadlines and all that sort of information to be available this summer of 2021. The third Treasury program we want to bring to your attention is the State Small Business Credit Initiative, which received $10 billion in funding from the American Rescue Plan Act. Eligible applicants include state departments or agencies, typically economic development agencies, but other agencies are eligible. And the funding is for states to help support capital access, collateral support, loan guarantee, loan participation, and venture capital programs serving small businesses in their state. And the application deadline for this funding is December 11th, 2021. And as I mentioned, there are links, I believe, to lists of CDFIs and MDIs in the reference guide, and as well as state allocations, initial state allocations under the State Small Business Credit Initiative. Going next to the U.S. Department of Energy, we want to bring your attention to the Section 1703 Loan Guarantee Program. This is a program that has been around a long time. It was originally targeted to the nuclear industry, nuclear energy industry, but has been changed over time. It's received $40 billion in total authorization. We were not able to determine how much of that authorization has been used and how much is still outstanding. And it's eligible for projects that employ new or improved technologies to reduce air pollution and greenhouse gases. As I mentioned, the kind of targeting of this technology of this program has changed over time, and we expect additional uses to probably be added under the Biden administration as final rulemaking is concluded. This assistance is in the form of guaranteed loans, and recent provisions that make this program much more potentially usable is that the funding has now been provided to from the feds to pay the credit subsidy and transaction costs associated with this program. In the past, the applicants or the recipients had to pay their own credit subsidy and transaction costs. And given that these are new technologies, it was often very cost prohibitive and made this program not very useful, has not been widely used in recent years. It's really targeted to technologies that are just new, becoming commercially viable, not for established technologies or for those that are in the research and development phase. And as I mentioned, new eligible technologies have been added, and we expect additional changes as well. The next area or the next department is the United States Department of Agriculture. Wanted to bring attention to some of these programs that have received funding under the COVID relief packages. First is the Rural Water and Waste Disposal Program, which received $1.9 billion in new funding. Eligible applicants include state or local entities, private nonprofits, and Indian tribes. And the funds can be used to provide loans and grants for water and wastewater disposal systems. Applications for this program are accepted on an ongoing basis through rural development. The Business and Industry Program, particularly the CARES Act provisions, received another $1 billion of new funding. Eligible applicants include agricultural producers and rural small businesses. And the funds can be used to provide guaranteed loans to increase employment, improve the environment, and or promote renewable energy. And applications, again, are accepted on an ongoing basis through rural development. And then finally, the Community Facilities Direct Loan Program received $3 billion in COVID relief funding. Eligible applicants include public entities, nonprofit corporations, as well as tribal governments. And the funds can be used to develop and construct essential community facilities in rural areas. Applications for this program are made through financial institutions, and the deadline for this round of funding is September 15th of this year. And then finally, the fourth department is the U.S. Small Business Administration. The 7A Small Business Loan Guarantee Program received $3.5 billion in funding under the CARES Act. Eligible applicants include for-profit businesses meeting the size, type, and underwriting criteria of SBA. Eligible uses of the funds are to provide loan guarantees to startup and existing small businesses. And the application process is ongoing through participating commercial lenders. And then the last one is the Certified Development Corporation, or CDC 504 Fixed Asset Financing Program, which received $3.5 billion in funding under the Consolidated Appropriations Act. Again, eligible applicants are for-profit small businesses meeting SBA's guidelines. And the funds can be used for fixed asset projects, such as purchasing land, constructing site improvements, buildings, conversion of buildings, long-term machinery, and other long-term and fixed assets. Applications must be made through certified development corporations and accepted on an ongoing basis. And you will find a search engine to find certified development corporations in your area. A link to that in the reference guide. And with that, I turn it over to David next, I believe.
Good afternoon, everyone. David Rosen, founder and principal of DRA. It's great to be with you. I just want to comment on the chat note I just left for the entire group. Nora made reference to a reference guide. DRA, with collaboration from Lincoln, prepared a detailed summary of each of these programs in a reference guide, which provides background information on eligible uses, eligible applicants, dollar amounts, and importantly, links to application sites at the appropriate federal agency and rulemaking and other references, such as lists of CDFIs and minority depository institutions in your state or jurisdiction, as well as allocation amounts under each of the programs. So I think the reference guide is an important tool, and I understand, RJ, that Lincoln has made this available to registrants for this webinar. I think at this point, we're really opening the discussion up among all of you as participants here to answer your questions and engage in sort of sharing and back and forth as to how your areas of interest can take maximum advantage of these extraordinarily large new resources made available under the American Rescue Plan Act, the Consolidated Appropriations Act of 2020, and the prior CARES Act, keeping in mind the issues of equity and social justice, which Mac reminded us of at the beginning of the webinar. So I'll turn this back to RJ.
Thank you, David. We are going to proceed now to the Q&A portion of the talk for a second. Just wanted to pause before we go to the next slide to see if there were any specific questions on the resource materials. If you have those questions, please do populate them in the chat and we will take them in order. First from Jess Wunsch, can you share the PowerPoint? We will make the PowerPoint available to registrants. Thank you for asking that. Our next question is from Gil Keenan. What programs give priority to projects that are in opportunity zones? David and Nora, do you have some thoughts on that?
Well, I think these programs have different definitions possibly of what like underserved communities or low and moderate income communities may be. And I don't know of any that are targeted specifically to opportunity zones, though I imagine there is a great deal of overlap, but that's something we'd have to look into to find out a little more specifically.
Can we go to the next slide? So these are, I'm going to click through these pretty quickly. These are detailed individual summaries of each of the programs that Nora covered in her presentation. Just wanted to flash them up on the screen and provide them as a reference for folks. Individual pages with the deadline, the eligible applicant, and what the program is designated or targeted for. So as we finish up going through those, I will ask again, if you have questions for us, to please put them in the chat and we will take them in order. Thank you. Okay, next question. Are there any of the Department of Ag programs available to assist local farming communities to develop collective capacity? Example, establishing and staffing agricultural collectives. David or Nora?
The two USDA programs that we profiled, can you hear me? I'm sorry. That we profiled are the Business and Industry Loan Program and the Rural Energy for America program. Those are not specifically reserved for agricultural collectives. So there is no specific set aside for that issue. Let's see.
All right, we are now going to sort of shift from the technical review and information on programs to a set of examples around either these federal funding tools or the financing programs that we've covered, hoping that these examples both prompt your thinking and additionally give you the opportunity to be inspired to ask some questions in about 15 minutes or so when we close this portion and move to the final Q&A about specific projects or programs that you might be interested in pursuing in your states or cities. So I am going to turn this back over to David to walk us through some of these innovative use cases.
Thanks, RJ. I believe, can you hear me? I'm not sure it's working here.
Yes, you're good.
Okay, thank you so much. I don't see myself on the screen, but you can hear me. Thanks, Lauren. A number of us on the call here are from a housing finance background. It's important to note that the large majority of funds in the American Rescue Plan Act are not specifically reserved for housing, especially housing finance and development. About $40 billion were made available for housing purposes, but fully 3/4 of that money is administered by Treasury in formula allocations to states and cities for emergency rent relief and emergency mortgage relief, fully $30 billion. HUD got another $5 billion in emergency vouchers, which really are not well suited for housing development finance purposes. But the home program, and this is a little bit related to the opportunity zone question from one of the attendees, the home program got another $5 billion supplemental appropriation to address homelessness and homelessness services for the homeless. Those funds are potentially usable for development finance. Having said that, the state and local coronavirus relief funds, the $350 billion referenced by Mac and RJ, do provide opportunities for housing-related responses to inequities associated and laid bare by the pandemic and the resultant economic calamity. There are a number of structural innovations that may be considered for using these funds. They include below market debt funds, public and private equity vehicles, real estate investment trusts, a version of real estate equity, mezzanine debt or equity funds for subordinate positions in real estate development, especially affordable housing, and portfolio level loan loss reserves for targeted lending. I'm just going to briefly mention a couple of examples from our own practice and then pause for questions from the group. First of all, with regard to loan loss reserves at a portfolio level, we're currently working with a regional foundation and a community credit union on a financing product for accessory dwelling units, or ADUs. ADUs are now seen widely as a way to provide naturally occurring affordable housing, as well as some income and wealth appreciation for low and moderate income homeowners who either have extra space in their homes if it can be restructured as an in-law apartment, or room in their lot, their backyard, to newly construct a home. The foundation in question is offering up a loan loss reserve against a $50 million portfolio of lending from the credit union, which combines construction takeout financing and subordinate position behind the senior mortgage for the homeowner. Another example is mezzanine debt funds. For our client in California, the city of San Jose, a very high cost, high price market. Google is in process of constructing 10,000 market rate units of rental housing downtown next to a major transit station, the Diridon downtown light rail station and subway station for San Jose. At the city's behest, we did a nationwide market analysis of mezzanine debt funds for market rate rental housing development and found that returns were in the 12 to 16% range, inclusive of management fees. And our analysis showed that if we were able to reduce the return to the mezzanine investor to 8% through, say, social impact investing, we could structure 10 to 15% of the units as affordable to families at 80 to 100% of area median income, far below market rent in San Jose, without public subsidy. And the mayor then used those findings to source socially impacted investors in this mezzanine debt fund. A third strategy was one employed by Ginnie Mae in collaboration with the California Department of Insurance and insurers active in the California market, writing down mortgage rates a quarter point to first-time home buyers in low-income and minority neighborhoods, because the actuarial data showed that the default rates and loss percentages for first-time homebuyers in minority communities were actually lower than those in higher income communities. So that's a couple of examples of how these alternative funds might be used, especially through the state and local coronavirus relief funds, and alternatively through some of the Treasury programs which Nora profiled. And I'll pause here, RJ, to see if there's comment or question on the housing examples.
Thank you, David. We do have a couple of questions here that we can take. Should states or localities consider putting coronavirus relief fund dollars into their existing housing trust fund models? Or would you recommend these funds remain separate?
This is David talking again. I think if there are existing and productive delivery mechanisms or models such as trust funds, and DRA has been involved in developing housing trust funds since the 1980s, I would say yes, absolutely. Use your efficient systems with good track records to expand your capacity.
Thank you, David. We have one other question before we move on from housing. When developing the capital stack to enable otherwise unbankable projects such as those in affordable housing, it seems that the programs and funding is coming online at an almost unmanageable pace from the feds. Are there models or case studies being developed or that you are aware of that we can point to or refer to about how to best sequence the more complex and fast-paced funding sources to achieve the outcomes that we want?
Well, David, again, this speaks to the point Mac underscored at the beginning, how opportunity serves those who are prepared, and kind of speaks to the trust fund question. So I would suggest that if in your state or locality you have models that are working well, these funds, to the extent they fit in the program guidelines, and in some cases these are emerging as we speak, I think simply increasing the size of your capacity to respond with capital is an efficient use. In other cases, I think new practice will need to be tested. We have a relatively poor track record of assuring that these funds go to resolve longstanding injustices across racial and economic lines in our country. Most recently with the rollout of the PPP program, the early data are not encouraging with regard to how well these PPP funds reached Black and Latinx business owners in disinvested geographies and communities. So I think this is a real challenge. I think in many cases, looking to your own local community for what works best now is one way to respond to this sort of fire hose that we're all drinking out of from the federal government right now. An alternative strategy would be to essentially organize politically with Treasury or other agencies to say, we need a little bit more time here to make sure that we don't repeat the mistakes of the past, and better integrate, say, minority chambers of commerce, or mercado merchants in inner city urban business centers to take better advantage of the business finance tools that are made available under the American Rescue Plan.
Thanks, David. The other thing that I would refer the attendees to is, in addition to existing capital delivery mechanisms that you have locally that have been proven to be able to provide resource, we have provided on the slide here some examples of other innovative practice that fits within this set of examples. They are the TOA Bay Area Transit-Oriented Affordable Housing, the Healthy Neighborhoods Equity Fund, and the Community Development Trust. So those links are in the chat, and we can slide to the next example.
So RJ, before you jump there, I noticed in the Q&A that Michael Badakin had mentioned that some localities were setting 8 to 10% of their funding aside for housing development. I know that we weren't necessarily prepared to do this, but I wonder if we could ask Michael Badakin just to, if Lauren can take him off mute, to just share at least a couple of ways that they're setting aside this money, because it might be useful for the rest of the group to understand that there are creative ways that people are using this money, and particularly around housing development, which is, of course, a hugely important thing if we're going to address social inequities, right? So I don't know, Lauren, can we take Michael Badakin off of mute and see if you can just
Should be able to talk.
spot, Michael, but maybe you could just offer like a couple of examples for us.
Thanks, George, and I don't want to hijack this at all. So I think the most important thing to say is that, as mentioned earlier, there's 50% of these funds have been delivered so far, and another 50% a year from now. So far, we uncovered about $10 billion that have been allocated by states, cities, or counties for direct housing investment per the May 11th Treasury guidance. By way of example, the city of Gainesville, a city manager is allocating funding for community land trusts. The city of Minneapolis mayor is setting aside a portion of the funds to reduce racial disparities in home ownership. The state of California is setting aside $2.5 billion, a large portion of which will be used to finance projects that will meet certain emission targets. The state of Delaware is being asked to set aside $85 million for preservation. And of course, there's a spreadsheet that I'm happy to share with everyone that tells everyone how to deal with the amazing amount of money that's coming your way. And it's important, I can't emphasize enough how much we should try to make sure what David said earlier and George said earlier, to target these funds for those who are most in need, and especially to try to make an equitable recovery. And thankfully, there's a lot of creativity going on the ground. I don't want to spend too much more time on this. I could talk forever about this, but I'm very thankful for the opportunity that you've given me to talk about it today. I think what David and Nora are doing is talking about other provisions which are all equally important. I would not be surprised if at the end of the day, a year from now, you'll see $25 to $30 billion in additional funding beyond what you're talking about here today being used for housing and community investment by states, cities, and localities with these funds.
Thanks, Michael.
Thanks, Michael. David, we can go to the next one because the next couple of questions are more related to business finance. So let's have you talk about that, and we can ask these questions and see if there are others from the panelists.
I'll be brief. I'm very mindful of time, and I think really the most productive use of the short time together is the exchange, just as we heard from Michael. And by the way, hello, Michael. It's great to see you. Business finance. So from a state agency perspective, the State Small Business Credit Initiative is critically important. We're talking about another $10 billion of capital made available directly to state agencies. Suggestions for ways to deploy these funds effectively with the racial justice, racial and social equity lens that we've, I think, all emphasized in this call include public deposits of funds with, this is a typo on this slide, CDFIs and minority depository institutions. We can provide you a link. I think RJ has it at his fingertips, and it is in the reference guide which DRA produced with Lincoln for this webinar, to CDFIs and minority depository institutions in your state. So partnering with these institutions is a critically important opportunity. We would certainly suggest structuring and or conditioning such deposits on express lending agreements to produce targeted business lending of the kinds your specific community want to see. Portfolio level loss reserves for targeted lending is another excellent way to de-risk a portfolio of small business loans to minority borrowers, women-owned business borrowers, nonprofit enterprises, and others who might not otherwise have bankable loans. Equity funds for minority venture funds, training and technical assistance and capacity building for minority venture funds, marketing and outreach. In the prior webinar, we spent a fair amount of time talking about the value of marketing and outreach to non-traditional borrowers, if we may. And a fund-of-fund approach where you're like not unlike a portfolio loan loss reserve, you're providing venture capital or equity across a number of intermediaries or managers. A couple of examples include targeted business lending, where we negotiated a 1% loss reserve across a $200 million portfolio of small business loans, personally guaranteed, non-recourse, no collateral, credit scored by way of underwriting for very small loan amounts in the city of Oakland, California, targeted to their community development districts, which track very closely to the high minority population neighborhoods of the city of Oakland. And this was a highly productive portfolio loss reserve strategy for the city of Oakland in this particular case. The next slide, if I may, unless there are questions on business finance, speaks to energy.
David, there are. Can I jump in here for 1 second?
Yes, please, of course.
Given the widely disparate impact of COVID on minority businesses and their relative lack of access to service from commercial lending, do you think the amount of funds targeted is sufficient to address the economic inequities we're seeking to eliminate?
Well, I guess my answer is twofold. No. And it's more money than we have had in a generation. So we do have a fire hose here. I, as one practitioner and advisor, I do feel, a felt responsibility and obligation to make the best possible use of these funds in solid partnerships with proven relationships and renewed efforts and energy focused on reaching previously underserved populations. But one kind of side note on this is there are specific set-asides for Native American and tribal governments and enterprises, and I was very, very happy to see that, having worked for some tribes, enormously disadvantaged and disinvested communities, and I think those set-asides are very valuable to that population. In terms of inner city populations, we'll have to do better than we did under PPP, where, as I've said earlier, there are emerging patterns of underserving minority borrowers.
Okay, we can go to the next one.
Okay, again, really going pretty quickly here. Energy efficiency and renewable energy development in housing. The Better Buildings program under the Obama era Stimulus Act, the ARA statute that Mac made reference to of 2009, spooled out under the aegis of the Department of Energy, their Office of Energy Efficiency and Renewable Energy. There were some efforts to coordinate both with USDA and their housing finance programs and with FHA. Frankly, they were imperfect. There is an excellent research bibliography of the results of housing retrofits for energy. At a portfolio level, there is potentially a lot of capital to unlock. We did an analysis for the Chicago Housing Authority, which has 25,000 units of public housing and calculated that at a per unit monthly savings of utility expenses of $50, the authority could finance $250 million in capital for retrofit and renovation of its public housing inventory. So it's potentially very valuable. And a number of the larger nonprofit housing development corporations, and for-profits for that matter, who've done LIHTC for the last 30 years, are now looking at portfolios of their own of 5, 10, 25,000 units. So portfolio level retrofit for energy efficiency and renewable energy and low-income rental housing is eminently doable here. Renewable energy credit enhancement for utility scale wind, solar, community solar projects, battery storage using the DOE 1703 program, which Nora summarized, are all examples of ways in which to deploy both USDA business and industry and rural energy for America loan guarantees, even frankly SBA loan guarantees, and under the 504 program and the 1703 program if we're talking about new and emerging technologies. We've also seen tremendous advances in the last decade in industrial scale agricultural projects, and particularly around greenhouse development, with talking about facilities of 1 million square feet and up, using highly advanced energy efficiency and renewable energy and water conservation technologies.
Thank you, David. We have about 10 minutes left, 8 minutes left, I apologize. So we do have time for 1 or 2 more questions. I have one that I can ask that was in the queue while we see if anybody else has a question. Please do type them into the chat. This is a comment from one of the attendees. Many federal agencies rely on CDFIs and MDIs to make investment into rural areas, yet very often CDFI and MDIs, such CDFIs and MDIs are not located, working in such rural areas. So developers and businesses do not have access to them. Do any of the panelists have comment on that or suggestions to try and address this and as a strategy to increase capital access to rural areas? My initial reaction to that is that there are some on both the CDFI and MDI score, and in particular on the MDIs, while they are headquartered in less states than all 50, as the question pointed out, there are some larger minority depositories that have multi-state presence. So I would recommend that if you're interested in exploring deeper partnerships with a minority depository institution, and there isn't one in your state, the list is sortable by assets under management. So if you identify some of the larger ones, they may have multi-state presences. Also, we do have some further information on that and are happy to, if folks want to contact me directly, share that offline about suggestions of larger MDIs that might have a multi-state presence to consider approaching for partnership.
RJ, may I add a quick comment?
Of course.
We didn't profile this, but another program in the American Rescue Plan is debt forgiveness for socially disadvantaged farmers, really defined as Black, Latinx, and Native American farmers in their producer capacities. There actually, there is a court challenge, which I believe has stayed this program. Perhaps one of the attendees has an update on the court challenge. I haven't read it. But I think the program has actually been stayed. I think 12 Midwestern white farmers sued the US Department of Agriculture to stop this program. But it is a significant program and represents one subset of important new capital and economic development opportunity for rural communities, especially among socially disadvantaged farm owners.
Thanks, David. We have time for one or two more questions if there are any. As you see, there is a on the screen. Have you thought about piloting any new product, program, or approach with either new federal resources, i.e. the Coronavirus State and Local Relief Fund, or the new project financing capabilities? So a question that we would encourage you to ponder. And if there are no, it seems we don't have any questions in the Q&A. So if Mac or David have final comments, we can do that. And then Lauren, if we could, in about 2 minutes, jump to the exit poll question. We're going to ask attendees if they would like a follow-up on a specific project or program. So you may be able to use that response tool to get some more information if that is of interest to you. Thank you all for attending today, and I'll turn it back over to Mac to lead us out.
Thanks, RJ. So I just a couple of thoughts that I have, and one thing that you might not know about the Lincoln Institute is that we're actually kind of a network of networks, and I think our greatest value add to the world is really connecting people who have experience and creativity to others who have questions and need help solving some issues that they're grappling with on the ground. And so we very much like to play the role of matchmaker. And so we do urge you to, if you're really thinking about trying to use some of these funds and you have some technical questions that you might need addressed, or you want to find out if there are other examples of people who are trying to do what you've done. As I mentioned when we started, we now have a working cohort of teams from 13 different states that include housing finance agencies, development finance agencies, other state level representatives with local representatives. And these local representatives can be CDFIs, development officers in cities, port authorities, other folks that are actually trying to find ways to work together differently to address a lot of the issues that we know have been so unassailable for the longest time. Like, how do we really deal with spatial inequality that has resulted from a lot of our own, policies, our land use policies and others. And so we want you to kind of look at us as a resource and to reach out, and we can do our best to kind of connect you to others who can help you answer some of your questions. And in the end, maybe you become another member of our network and a resource for others as your experience becomes something that could be useful for them. So we really do hope that this is just the beginning of a longer conversation. We know that it's going to be years to kind of dig our way out of all the different kinds of ramifications of the COVID pandemic, and to rebuild a lot of things like all the supply chains that are so broken right now that we're trying to find ways around in the world. And I think that for us to make sure that all the panicked activity that takes place as a result of trying to kind of unwind the bad impacts of COVID, we have to make sure that we just don't leave people behind the way we've done so effectively in the past. So look at us as a resource, ask us the right questions. We'll do our best to kind of connect you to people who can help you with the answers. And together we can try to find ways to make this recovery more equitable than it otherwise would be. And I think that would be a real contribution. So I really thank you for your time today. And I think RJ and the rest of the team are going to just ask you a couple of exit questions, and look forward to another opportunity to talk with you in the future. Thanks. Bye now. Okay, here's the poll question, right? Please indicate if you would like to request one or more of the following, and then you can ask us for like a phone call or some assistance, and we will promise to follow up with you if you indicate something that you want. Okay. RJ, I think is it back to you?
It is. Thank you all for coming. We are going to leave that poll up until the close of the event, which per the clock is now. If you haven't had a chance to vote, we'd ask you to do that before you log off. And I'd like to, on behalf of our project team on ACI, I know Mac and I and our colleagues at DRA are all appreciate your time this afternoon, and please do reach out if we can be of assistance. Look forward to hearing from you, and thank you again for joining us today.
All right.